Hello, this is George Geis. Welcome back. In this video, we're going to be talking about the liability and shareholders' equity section of the balance sheet. Remember, the balance sheet represents financings and investings. So now we'll be talking about the financing piece, sometimes called the right-hand side of the balance sheet. Now, remember we were dealing with Microsoft, and we were taking a snapshot of its balance sheet as of June 30th, 2014. Now, by the way, you also see 2013 show up because this is pretty common when a company reports a balance sheet. It takes two snapshots so that you see what changed from year to year. So we have June 30th, 2013 and June 30th, 2014 on this company's balance sheet. Again, we're focusing on the liabilities and shareholders' equity, the financing piece of a company's balance sheet. And I just want to highlight a few of the accounts on this side of the balance sheet. First of all, notice we have accounts payable, about $7.5 billion. This is what Microsoft owes to its suppliers as of June 30th, 2014. Not a trivial amount of money, but again, that's a source of financing. And some companies, by the way, have been very clever in using accounts payable to grow the company. Think of Dell Computer, for example, in the 1990s when it had a unique model, which was subsequently copied by a lot of other companies. Dell would take an order for a computer, let's say a personal computer, get your credit card, which turned into cash in a day or two, and yet had 30 days or more to pay its suppliers. In essence, this was a clever way to finance the growth of the company, to generate, by the way, what we call free cash flow, but more on that a little bit later. Then we have accrued compensation. Notice that that's $4.8 billion. That's what Microsoft owes its employees as of that date. That might include the fact that that employees have yet to be paid for work they've done. It might include things like vacation pay, which also needs to be put into this account. But those are employees that are, in a sense, providing financing for the growth of the company, a liability. Then I want to spend a little time talking about short-term unearned revenue. Notice the gigantic size of this account, $23 billion. What is this? Well, in this case, what Microsoft has received, and what is happening is Microsoft has received cash, but it's not yet delivered the services. So anytime, if you're on what we call an accrual basis of an accounting, accrual essentially means is that you have to earn income or revenue, in this case, before you can actually book it as revenue. So here's what's occurring. You're paying Microsoft money, let's say for its Office software. They claim, or Windows operating system, they're holding back some of that money as if they have not earned it. Or maybe you pay in advance for licensing for a year for a enterprise software. Now let's deal with one of these in particular because it became an issue for Microsoft that it had to resolve. And the issue was this. Microsoft claimed that it had not earned all the revenue, even though it had received the cash, let's say for Windows. And the argument was, if you probably experienced this, if you're a Windows user, that you get updates periodically, maybe every couple of weeks or every month. So Microsoft is saying when it sells Windows, the product, in essence, is not complete. They have updates yet to do, which they anticipate. So they hold back some of that revenue, do not recognize it, and they call it a liability, short-term unearned revenue. They have not yet performed all the services that are needed to claim that they have completely earned that revenue. Let's give you a couple other examples of how this account could come about. Let's say you subscribe to a magazine. You pay for 52 issues, weekly issues, and you pay $52, let's say, $1 a week. You know, that revenue is unearned revenue. It's a liability for the publisher. Why? Because the publisher has yet to fulfill the obligation to earn the revenue, which means shipping magazines. Or let's say you buy a ticket on an airline. Until the airline delivers the flight, it may very well be unearned revenue because they have not fulfilled the obligation. Or maybe you're a football fan. You buy season tickets to a football season for a team. It's unearned revenue for the owner of that football franchise until they deliver the games. So consequently, in Microsoft's case, you see a substantial revenue of $23 billion, which they claimed is unearned. Now, most companies want to recognize revenue as soon as possible for financial purposes because they want to make the revenue and income statement look as positive as possible. In Microsoft's case, they're holding back a substantial amount of revenue, which they've not yet recognized. Now, it turns out that what occurred is that Microsoft was told they better be very consistent in doing this because reporting agencies in the United States, we have the Securities and Exchange Commission, Financial Accounting Standards Board, said you guys better be consistent because otherwise what you have here, if you think about it, is a cookie jar reserve, which means Microsoft could, if they had a bad quarter or a bad year, you could accelerate and take more of this unearned revenue into revenue, saying now we've earned it. And Microsoft was told they had to be very consistent as to how they deal with this question of unearned revenue. But I want to point out that if you have received money for your venture in advance and have not fulfilled the services, you may very well have unearned revenue to deal with on your balance sheet. Now, a couple other accounts here which are important to long-term debt. Notice Microsoft now has $20 billion of long-term debt financing. Many technology companies in the past did not take debt. They didn't need to. But in 2014, 2015, debt became so cheap that many companies, including Apple, Microsoft, and others, were issuing substantial amounts of debt in order, remember to go back what we said before, you want to drive down your cost of financing so that your return on your investments are higher than your cost of financing. Remember that prime equation we've talked about? Well, if you're getting 1 or 2% long-term debt or 3% long-term debt financing, that's very cheap capital. So many companies, including Microsoft, have increased the amount of debt. Notice that from 2013 to 2014, it increased substantially. Finally, look at shareholders' equity. The shareholders' equity section is the value that's associated with owners. In the Microsoft's case, it's now shown to be $89 to $90 billion. Notice that is comprised of what investors paid in. That's around $68 billion. What is retained by the company from earnings, another 18 billion, and then another account which has to do with other comprehensive income, which we'll discuss perhaps later. But the point I want you to see is that all these comprise shareholders' equity of $90 billion. Now, one important point. This $90 billion, 89.7, is what we call accounting book value. That is the book value of Microsoft. This is not the market value of Microsoft. The market value is what investors are willing to pay for Microsoft's stock in aggregate. That might be 4 times as big, 3 to 4 times as much, 200, 300, 350, $400 billion, depending on the fluctuation in the market. An important point for you is that the value of your company as a venture may not be reflected by what we call book value or your total shareholders' equity. Remember we said before, some assets may not appear on your balance sheet that are very important for your business going forward. And some assets may be undervalued. So total shareholders' equity looks through the rear view mirror, whereas market value looks forward as to what the company has the potential to produce in the form of cash flows and income going forward. So at the end of the day, if you look at total assets and total liabilities and shareholders' equity, you'll see that these two accounts line up. These two totals are exactly the same. In summary, we've seen that assets equal liabilities plus shareholders' equity on the balance sheet. That investing equals financing. Now, we've been focusing on the financings in this video, both the short term and long term, both from creditors, liabilities, and both from shareholders or equity. The equality that investing equals financing is why we call this the balance sheet. But remember, this is the primary vehicle whereby anyone looking at your company will be able to determine where you've made investments, what your financing has been as of a particular date. Now, going forward, looking ahead, we're going to next be talking about the second of the big three financial statements, and that will be the income statement.